Hey, good afternoon. Mike Shea, your Florida business broker, and today we're going to talk about 12 fatal mistakes you can make when selling your business. But first, I want to talk about two statistics that should really be top of mind when you're going through this list. The first is that less than 20% of the deals that could go in the market here in Florida ever sell. And the reason for that primarily is sellers fail to prepare and the books and records aren't in order. And then, frankly, there's a false expectation in terms of pricing from a seller standpoint to what the market bears. The second statistic that should really concern you is that the average business broker lasts in this business about 2 years. And the reason is closely tied to the first statistic I threw out. It's really hard to make a business and make a living in this business. And you have to have resources and a good network to get deals done effectively here. So what's the first mistake you can make? The first mistake you can make is failing to keep your business sale confidential. It's kind of counterintuitive that you're going to sell a business and market it and yet maintain confidentiality. But when you think about it, it's real dangerous to let your employees know that your business is for sale. They start to worry about things, unnecessarily, but they'll worry nonetheless. And then your vendors, your customers, your landlord, those people start to ask questions, and it takes unnecessary energy away from you running your business. And also can cause problems. So a good business broker will maintain confidentiality, will have certain documents to maintain and protect you, and get you to the closing table so that the deal gets done quietly and effectively at the best outcome. The second mistake you can make is failing to run your business. So a lot of entrepreneurs, when they go and talk to business brokers, kind of have a little bit of a heart attack when they talk about fee structure, and they look at that expense and they go, well, I can do it on my own. Well, when you do try and sell your business on your own, you quickly find out there is a ton of work associated with it. There is paperwork, there is document collection, there's document preparation, there is cost associated with properly advertising to create competition. And then there's a series of phone calls, emails, back and forth, and negotiations that have to be done. And when you think about it, every minute you spend running your deal is time separate from running your business. And invariably what's going to happen is your business is going to suffer. And if your suffering happens, then the results are going to go down. And when the buyer asks for an updated set of books, the profits are going to be down, and then you're leveraged. So it's real important that you run your business and you hire professionals. Just like you hire a CPA or you hire an attorney, you should hire a professional business broker, because they're going to run that deal and keep you focused on your business, not on doing work associated with the deal. The third mistake you can make is failing to properly negotiate. So, professional athletes know how to negotiate. They hire agents. They don't get emotional. They have context for what's a doable deal and what's not a doable deal. As a business owner, you have one perspective and a buyer has another perspective. And a good intermediary knows how to negotiate, how to set terms, when to blink, when to bluff, and when a good deal is a good deal. So again, kind of ties in closer to number two, but number three, failing to negotiate properly can hurt you in the long run. Number four, failing to talk to a qualified buyer. There are hundreds and hundreds of emails that I get every day on our listings. And if you don't believe me, call me and I'll show you. We do a really good job of weeding out tire kickers. 90% of the people who reach out to us never pull the trigger. We actually have a database where we've tracked people who have looked at multiple deals, and we know who they are. We also know the profile of which someone is realistic about their expectations of what the market is going to bear, first what they're going to get in terms of ROI, and what kind of deals are structured. The internet is riddled with people who tell other people they can get deals for no money down, or that a seller is going to finance 90% of a deal, or that they can go to a bank and get a loan. Brokers who are experienced in the business, who have been around a long time, know what's doable and what's not doable, and cut through the time wasters really, really quickly. So think about it. If you don't hire a broker and you've never done a deal, you go out there and start talking to tire kickers, you're wasting a ton of time. And then again, there's that negative impact to your financials. So number five, failing to move a deal along quickly. We have a word in our business, or a phrase in our business, called time kills deals. If you're doing bank deals, there's quarterly reports. Deals are like fish. They get old, they start to stink. People start to think. Life can happen, circumstances can happen, family money can happen, the stock market can happen, heck, COVID can happen, and change deal dynamics really, really quickly. So a good broker, I've heard it called bird dogs a deal, and can get it done quickly by moving the buyer, the seller, and all the associated professionals, lawyers, accountants, attorneys, closers, landlords, to the closing table as quickly as possible. Number 6, failing to price the deal correctly. So we've been around for 42 plus years, and we've collected some recent data and went back. We knew this intuitively, but overpricing a deal 15% higher than what we tell you will frankly result in your business not selling. If you overprice a deal because you think that you don't want to be the first one to blink, well, guess what? Sellers and brokers alike, or buyers and brokers alike, know what a deal should be properly priced at. B, we're not going to be able to get it financed, or we're not going to be able to get the best terms, which means you're going to have less buyers looking at your deal, which means less competition. And if a deal sits, buyers start to think you're leveraged. So you got to price your deal right. If you price your deal right, the brokers in a co-broker environment know it's priced right, and they will bring buyers. And more buyers means competition, and competition means your deal is hot, and you can get a multiple bid situation where you hold the line on your price and terms or get higher pricing terms because your deal is properly priced. Number 7, failing to properly structure. What's doable, what's not doable, what is bankable, and what is not bankable. Knowing that in advance, 2, 3, 4, 5 years in advance, and getting your business prepped to sell makes all the difference. If you've run your business in such a manner that you don't have to pay taxes, and then you're a multi-million-dollar business and you expect buyers to pay you cash, you will not sell, because the buyers are going to try and leverage because they're smart. And without the ability to finance with a bank, you're probably not selling. And then you're stuck with an asset that's going to sell basically on the value of the fixed assets, not the value of the cash flow. So talk to a broker well in advance and understand how deals get structured properly and what is the norm in the market. Seller finance a real deal. It does not mean 20% down in the balance finance. It's more like the inverse, where we're financing the value of the assets that are lienable, which is a protection to the seller. But you got to structure your deal correctly, given the marketplace and the realities of finance and how banking actually works. Okay, failing to prepare for due diligence. Just like I tell buyers and sellers, more importantly, sellers, they should prepare in advance years ahead and know how deals get structured. You need to know what is going to be asked of you prior to going to market. You got to realize they're going to ask for bank statements. You got to realize they're going to ask for your tax returns. You got to realize they're going to do a phase 1 or phase 2 if property is involved. And you need to have all those things prepared and in line. And a good broker is going to collate that and tell you what those expectations are. There will be other things, because due diligence requests comes from CPAs and attorneys, but we can give you a good, clear understanding of what's probably going to be required. So remember, prepare for due diligence before you get to due diligence. Okay. The next one, failing to create competition. Number 9, failing to create competition. Yes, your deal's good. Yes, your business is good. But a good broker creates competition. Competition is good. Having more buyers looking at your deal is better than having one buyer look at your deal. If there's only one, then you have one chance to sell. If you have 5, you have 5 chances to sell. So a good broker should be measured on their ability to market, their ability to create competition, and the amount of co-brokering they do. You got to make sure your broker has a history of co-brokering, so that they will get the most buyers coming to the table, so that you as the seller get to pick and choose who's the best deal. Number 10, failing to get the right professionals involved. Not all attorneys are the same. Not all CPAs are the same. And just because your CPA has been doing your books, they may not be the best CPA for the deal structure. Depending on what we're dealing with, if you're a private equity deal and the buyer's a private equity company and they've got a team of attorneys, your family attorney may not be the right person to handle that deal. And they should know that. Don't get it twisted that your broker is trying to tell you to pick a different attorney because they're working for some untoward reason. They're trying to get someone who's got the experience to manage the volume of work associated with the transaction. So listen to your broker and have a serious conversation with your professionals if the broker and you have decided someone else is the right fit to handle the deal. Because let's face it, a CPA in the middle of tax season who does tax records is not going to be able to handle the volume of work coming from a private equity group. God forbid your deal's going down on April 15th. Number 11, failing to properly package the deal. We do things like Sims. We do video packages. A deal must be packaged in such a manner that a buyer will look at it based upon a short amount of information and make a commitment to buy. Slapping an internet ad is not enough. There needs to be supporting documents to back up the deal in what's called a SIM, a confidential information memorandum, that provides a limited amount of data in such a format that the buyer feels confident that it's a good deal before you go to due diligence. One of the things that happens is sometimes you give too much, and if you keep giving too much, you never get the contract. There is a process to this, and they have to hit certain trigger points. But the packaging of the deal is really, really important to get to that first step, second step, and third step. And then finally, number 12, failing to control the deal. Your broker needs to be that bird dog, needs to be that person who will control the attorneys, the accountants, the buyer, the buyer's attorneys and accountants, and hold on to your horse, you as well. Although you're in charge, that broker has to have the ability to tell you no, tell you yes, and tell you maybe, and also the consequences of the requests you're asking for when you're asking. Because their objective is to get the deal done in a safe and profitable manner so you have the maximum outcome. But again, there's a process. Your broker, if you've picked the right one, has the experience and the knowledge and the resources to tell you what's doable. Yes, you're in charge, but you darn well should have hired the right person. So think of it like a doctor. And you go out there and you've got a cancer diagnosis or a heart surgery or something else that has to be fixed, and you've got multiple, opinions because it's a serious situation. You've probably picked the one who's got the best background, the best training, the best education, and the most experience to do the deal. I hope you've done that with your business sale, because there's only 1 or 2 times in your life that that's going to happen. So go through these 12 items. These are the 12 mistakes you can make as a business owner when selling your business. If you have any more questions, I can be reached at 321-287-0349, and it's Mike Shea at Transworld Business Advisors. Have a good one.